Well, good morning, folks. I'm probably a little bit louder today. Apparently, I wasn't doing something right in OBS. So it looks like the microphone is screaming. So you should have no problem hearing me today. So we're looking at the ES here. I apologize for my tardiness. I was trying to get this thing to open up. It was taking forever to do it, so give me 1 second. How are you doing, by the way? Doing good today? I am blessed. Thanks for asking. All right, so we are looking at a fractal in price. There's a bit stuck. We'll see if we can work our way out of that this morning. Don't worry, I'll talk about what you're seeing here in a moment. Just let me get my chart here set up. All right, so this was a breaker this morning I was watching just to see it run. The breaker being here. Watching that pre-830 PPI number. And then watching the 4132 buy side, taking it back to an old new week opening gap. Again, as a reminder, this little shaded area here, that is the technical present current new week opening gap. But we had holiday volume and such last Friday, so I like to use a close proximity new week opening gap. So that's what you're seeing here, this low and this high respectively. But I keep that shaded little box on there. That is the current, where we stopped trading on Friday of last week and where we started trading on Sunday. Okay, so that's new week opening gap definition. And this little shaded area here, for those that are wondering, that was the magic behind yesterday's PM session highs here. So you may have been taken off guard with why it went up here and stopped dead in its tracks. If you go to down here, regular trading hours, that gap in there, you extend that forward, and you'll see that that is, in fact, the reason why we stopped. But that was yesterday. We're focusing on this morning. That green rectangle is that fair value gap right there. On your 5-minute chart, it is the 2:50 p.m. Monday. So that's what you're seeing there. Why am I considering it? Oh, it's the start of the week. It was an initial fair value gap. So much like I teach with the fair value gap that's in the opening range being the first 30 minutes of trading from 9:30 to 10 o'clock. I like to look at that as a, I know there's a lot of you that probably like to use that volume profile, and for the life of me, it's escaping me. There's a specific value you guys like to look at, and I don't subscribe to volume profile. I think it's just another excuse to get into a trade like anything else, and you can attribute my stuff the same way. But the initial fair value gap that forms in the first 30 minutes, I like to treat that as a very influential reference point throughout the day. And how we move away from it, is it respected at all? Is it disrespected? That helps me frame a lot of narrative for the day. I'm not all that terribly interested to just get 5 handles, but I teach that as a a low threshold for all of you. This was a volume imbalance I was watching this morning, so we laid a body down over top of it, so I'm not interested in it anymore. So that's why I'm going to take it off. And I just want to be fair and walk you through why I have these things on the chart. So I know invariably you're going to be wondering, what is that there? What is he hiding? Not hiding anything. It's just sometimes these annotations are no longer useful for me. And I haven't got to the point of taking it off yet. Bear with me 1 second. Okay, so we're watching how buy side was taken here. And dollar index this morning has been animated to the downside after that PPI number at 8:30. So let's take a quick look at the DXY rather. DXY, TBC. Okay, so that's what we're looking at here for the dollar index. And if you look at what we have on the daily chart, this is something I've been watching and prompting my students to look at. We would see likely this sell side be reached into. What's important is how we trade there once we get below it. So if we hammer through it and start to accelerate, then that's going to obviously give a lift potential, not immediately or because it's only done this. It just opens up the likelihood that ES could trade higher. Even though I gave you an analysis last night, I'm looking for a reason for that weekly imbalance on ES to draw price lower. It does not mean I'm here today to force that. So that's not what we're trying to do here. I'm not trying to convey that as a teacher or mentor. But this draw lower on the volume imbalance in here. Let me zoom in a little bit. I just realized I haven't asked you all to do a sound check, so I'm kind of chancing this. I don't think I've done anything incorrect, but I've done recordings before, and there's been no audio coming through. But there's the volume imbalance we traded up into. Ran sell side here. Sell side resides below that. Do we hit that, reject, and start to trade higher? That would be favorable for what I was outlining last night for ES. But let's go over to ES. Okay, and you can see that we've taken out this high. I'm going to take some of this stuff off now because it's a little too much and I don't need it now. All right, so we had this rally up yesterday, took out buy side, just fell short of the opening price here on that candle by one tick. And I won 41.80, didn't get to that. So I believe that the sell side below here, that little bit of imbalance, might be enough to draw a price lower if dollar can mount some kind of reversal after taking its daily sell side. Now, all that falls apart and is nullified if we accelerate on the downside with the dollar, and that provides lift for ES or potential for ES to go higher. Euro dollar, obviously, and pound dollar are much higher as a result of the dollar being weaker. NASDAQ is running higher here. Hold on, let's go to a 5-minute chart. And we'll go to a NASDAQ. Much more strength behind the NASDAQ. So we can use that six sister idea now. Since we're seeing leadership between ES and NASDAQ, NASDAQ leading on the upside, we could see this as a breaker. So it's low, high, lower, low. This up close candle here, higher up close candle, extend that to the right. Okay, we traded there. And we would want to see price run through this fair value gap right there on the upside, if it's going to follow suit with with NASDAQ. So this is a 5-minute chart. And I'd like to see it run up, come back down, and treat this fair value gap as an inversion fair value gap, IFVG, is what you'll see me annotate my chart with when I'm doing that. The problem is, and this is what I was referring to, we were in a fractal that's kind of trapped between bullish and bearish. And I know you guys are probably getting sick of hearing that, but this is how you learn how to read price action. You don't shy away from these types of conditions because you're going to be presented with them in the future when I'm not doing live streams and you're wanting to participate in the marketplace. You want to know what it is that you should be doing, what you shouldn't be doing. So while NASDAQ has been raging higher, the Dow, let's take a quick look at that, said I'm not coming to the party today. So it went lower. It's taken out sell side. At the same time, NASDAQ higher. So right away, by looking at all three averages, are we looking at a symmetrical market? If you've been keeping notes, symmetrical market is when they're all in agreement and the dollar is supporting that same movement. Dollar's weaker, all averages should be going higher with the Forex pairs. We're not seeing that with the Dow. And there's lethargic price action in ES, which can lead to the sick sister concept, which is where it catches up with the leader. In other words, this might want to run above for buy side, trade into that new week opening gap high or consequent encouragement. Roughly eyeball, we'll call it 38.75. 41.38.75 is the consequent encouragement between this old new week opening gap and old new week opening gap high. So respective low and high and midpoint consequent encouragement, 41.38 3/4. I would sit on my hands, do nothing here until we got above this fair value gap. Why? Because it's already showing respect of it. So I don't want to step in front of that and try to go long. Because why? The market's not symmetrical. We're not seeing all three averages moving together in tandem, where they all should be all three going up in agreement, confirming each higher high. In other words, if there's a higher high in NASDAQ, there should be a higher high posting in ES, and there should be a higher high posting in Dow. That's simple Dow theory. Blending intermarket relationships and market analysis is by taking the risk on, risk off scenario by incorporating the dollar index. And since the dollar index is weaker, we would be expecting all three averages to move higher, but we're not seeing that yet. So therefore, we exercise patience. Where everybody else is in here clamoring to do something, I'm not. I'm sitting still waiting. I'm not fearful of missing anything. I don't care if it takes off without me. I'm sticking to a pattern with rules. These things tend to repeat once everything gets in alignment. And if it's not going to be in alignment, that's fine. I'll sit here and jawbone about how it was good for me not to do so, and you'll get experience. Even if I bore you to death, you'll get the insights that you should lean on later on when you don't have access to me live. So what's it going to take for the market to return to some normalcy? Okay, I see a lot of that in the comment sections, a lot of posts in my older videos, people complaining like I have some kind of control over what markets are going to do. I appreciate that, but that's a little outside my influence, let's put it that way. We have to wait for the market to get out of this daily rut, the chart, the daily time frame. That needs to loosen up. We're stuck in that little bit of a funk, if you will, on ES and NASDAQ and Dow. So there isn't a lot of people out there saying, you know what, this is the perfect market to throw a lot of money into it. There's a lot of risk right now. The geopolitical stuff, you know, if you haven't been paying attention, there's some tension on the other side of the world. And all kinds of banking shenanigans going on. So there's a lot of concern about assuming risk. And the level of money that is sitting parked right now is large. And that needs to be inspired to be either scared, so it looks to make a move, or inspired to take on risk. And we haven't seen that yet. So we're forced to look inside these smaller little time frames and scalp That's what you're in. You're in an environment that is for scalping predominantly. And if that doesn't fit your model or your personality, what you're supposed to do at that time is exercise patience and do things outside of trading to take up your time. Study, back test, all that, but don't try to push the button because you're going to try to do something that's outside of your unique model. But the wonderful thing about teaching intraday, lower time frames is there's lots of examples for me to teach that stuff still works. Also, it'll help you refine, even if you have a swing trader's mindset or a position trader's mindset, you can get into trades a lot more precisely, limit the exposure to larger stop losses. Not that I'm trying to promote the idea of ultra small stop losses, but obviously you can see that there's a benefit that comes along with trading these lower time frames if you're in sync with the higher time frame. Give me 1 second here. Okay, hold on. It's a little intimidating. I'm pulling up Twitter to make sure you guys can hear me, but I saw how many people are watching live. It's a little intimidating. I don't feel comfortable when I see that. I just want to ask you all on Twitter if you can hear me. I don't want to do a stream and not have the audio behind it. I didn't bring my cell phone with me to my trading room, so I'll be able to hear it. Thank you, Rob. Is the volume okay? Volume loud? I know sometimes everybody complains. Volume's good. I'm looking specifically for the volume. Not in charts, but awesome. Okay, thank you so much for that. All right, so what we have here is we have a swing low in here. And remember that Monday fair value gap? See how it's respecting that right there? So we have a swing low after trading down into a bullish breaker. I want to see it trade up into the consequent encouragement, 41.38 3/4 to 41.40.50. And then if, and again, this is all contingent upon dollar index continuously weakening. So I'm looking at the 5-minute chart on dollar, and I want to see it not try to turn here. See it just erode a little bit more and see if we can get up into this new week opening gap here. But this swing low, this is that single candle here, the long wick candle to the downside into this bullish breaker. Low, high, lower low. You traded down into it here. We had a higher low on this candle right there. And we're showing initial signs that it wants to support price at that old Monday fair value gap, which is an initial fair value gap that I like to extend that through the week. It's kind of like a I just had the word this had the term you guys like to use for volume profile, and it escaped me again. You can see I don't use it obviously, but it's driving me crazy. My OCD is flaring. It's going to distract me until I know what it is I wanted to say. But either way, we want to see price trade above and then respect this fair value gap. Run the risk of, if it does go higher, it doesn't even come back to that fair value gap. And that's the only thing in these types of conditions where we've had the NASDAQ perform so strongly on the upside. Dow's firming up a little bit, but using this type of strategy, which is the Six Sister concept, where it's kind of like playing catch up with the leader, where one market's leading and maybe indicating, I'm not saying it's absolutely the case, but it looks as if the NASDAQ is supporting a willingness to want to go higher. And I think there's unfinished business with ES at that 41.38 level. So 41.38 3/4 would be consequent encouragement or midpoint between the new week opening gap high and and the low. Now, that's not this present week's new week opening gap, so don't be confused by that. It's an older new week opening gap, but it's in close proximity to the actual one for this week, which I don't trust because we had holiday volume and holiday schedule. So that's the reason why I don't like to utilize it for that reason. I think I've already talked about this, so I don't want to beat you up with the old stuff I already said. So what constitutes a return back into that for a inversion fair value gap? I need to see it trade above it and then start, at least the very minimum, a new candle. So since we're looking at a 5-minute chart here, I require it to be above it, close it, and then start a new candle where it trades down into it. It cannot trade above it and pass back through it like it's doing here. That to me is not rising above it and coming back down. That doesn't fit the conditions I'm looking for. Just want to cycle through the averages again real quick. Now for Dow, I'd want to see it trade above this fair value gap right here. Treat it as support and then run for the buy side. If in fact the dollar does continue going lower. We don't have that yet. We don't have anything supporting that idea. It's just a speculation on my part right now. No setups for me as of yet. NASDAQ, let's take a quick look at that one. So we have a bit of a buy side imbalance, sell side inefficiency in here. Swing low. Now stops would have been trailed below that. So if it didn't drop down in here, but leave this open somehow. Don't close all that in. In other words, don't go all the way back down to that candle's high at 13,030 and a half. I wouldn't want to see that if it's going to go higher. So we would want to see it remain open partially. It can come back down here a little bit. That's permissible. I wouldn't have any concern about that removing short-term bullishness if dollar fails to rally. So in other words, dollar has to remain weak. It can consolidate, but it just can't rally. If it rallies, that makes this problematic, and it might want to slip below this fair value gap, which would undo my initial interest this morning. And none of this really changes the thing that I outlined last night for where I think the ES could eventually go to. We have plenty of time between now and where we close on Friday. So anything can happen in a short span of time. But I'm reading the price action right now. So I'm not limited to just one trick pony concept or one model. I want to be able to teach you how to be flexible as well, so that way you can grow outside of your model that you've adopted initially. Your first model will always be near and dear to your heart, but it's probably not going to be the one that you spend the rest of your career as a trader using. Will you have dozens of models? Probably not, but you only need one, and you have to start with one of them. So we had one more pass into this fair value gap. Or this entire candle here is an order block. And I'm watching how we behave inside its range from this candle's low and this candle's high. Dollar's a little firm in here at 100.91. But it's a fair value gap in the form of a city on its 5-minute chart. You can find that on the Dixie at the 9:30 candle, 5-minute basis. Again, we're submitting ourselves to the first 30 minutes. That's the opening range. Being patient, waiting for some measure of displacement to occur. So far, we haven't had that yet. NASDAQ still looks firm in here. Dow still looks like it's a heart attack. Euro's a little softer off the tide cable, which is pound dollar. It looks like it's trying to consolidate in here. It has a buy side and balance, sell side efficiency that can trade down to 125.15, 125.14-ish. If we lose that, that might be problematic, and would open the door for a little bit higher dollar. Nothing in this chart here indicates action. In other words, actionable response as a trader would look at and say, okay, let's go in and take on risk. All I'm doing is I'm speculating that it could trade higher and reach for that 41.38 and 41.38 3/4. But nothing here bolsters my confidence to do so. The other reason why we wait for something like this, and I utilize the inversion fair value gap, think about what we saw at 8:30. Okay, pretend you're sitting down at your chart for the first time. You only see what you see here at present. You don't have any idea what I talked about last night. You don't have any preconceived bias. Nothing. No influence at all. And you sit down, you see this. At 8:30, what was the rush to do? Take out buy side. All these highs over here had buy stops resting above it. So at 8:30, in one single pass, it ran up there, traded into an old new week opening gap low here. And then did it stay up there? No. But it was in a rush to go there, wasn't it? And since it has happened, what has price done? Has it reversed? No. Has it come back down to some measure of fair value? Yes. A discount bullish breaker. It's offered multiple passes in Monday's initial fair value gap. But we're watching this fair value gap. So I'm teaching you, yes, there are fair value gaps here. And just because an indicator might be out there that someone's coded and they see a separation between one candle and a candle 2 candles later, that does not mean that's a tradable inefficiency. It doesn't mean that's an ICT fair value gap. It just means that, yeah, there's an imbalance there. What makes my concept mine is how I utilize it within a narrative. So yes, I did invent the concept. I know you guys like to say I didn't because it makes it feel better that you're not underneath my tutelage. I don't care if you consider me your teacher, but you're not going to say I didn't invent this stuff because I did. Imbalances have always been in the marketplace, but how I incorporate them in my analysis and tape reading, that's the unique part. See how the bodies of these two candles here are respecting that fair value gap? So incorporate that with the rush to get above here for the buy side. It went up to a premium array, which is the new week opening gap low, an older one, but still nonetheless it's there. And then the market trades back down into bullish breaker. Have we seen animation to the upside? Was there a desire to quickly and aggressively run to new highs after it traded to the breaker? Not yet. What's holding it back? This fair value gap, which is why I said we'd have to wait and see, does it want to give way, trade above it, and then start a new candle and trade down to it. That is the minimum. That's the minimum. Otherwise, I sit still. I don't do anything. None of this causes any regret for me. I don't feel like I missed anything. I don't want to chase it. I don't care. It's going to do something that makes sense to me before it does it. I'm not looking at price saying, oh, this is that whatchamacallit. No. It's either going to do something I'm expecting or I'm doing nothing. That's discipline. That's trusting your experience and your model and what you're looking for in price action. I'm not reacting to price. I'm anticipating what I want to see in price to deliver within the narrative that I'm expecting to unfold in price. That's a whole lot of mumbo jumbo, I know, but long story short, I'm waiting for a setup that fits the criteria that I have. And nothing in this movement so far makes me feel like I need to do anything yet. And that is a That's a superpower for a trader, okay? If you're a trader, if a trader was a superhero, what characteristic would you want to have as a superhero? If a trader was a superhero, invincibility, that's what a neophyte wants. A never losing trader. Well, they don't exist, because even kryptonite, it looks like jade, doesn't it? But it's not, and it's Superman's weakness, right? So everybody, regardless, they always have some kind of flaw, some kind of weakness of some sort. But a superpower that every trader should aspire to have is self-control, patience, and understanding about how they're going to react. How are you as a trader going to look at price action like this? And every time it dropped down like that, I guarantee you, some of you were salivating. It's going to go down for those relative equal lows at 8 o'clock and 8:30. It could have. I'm not thinking that. I'm thinking it's stuck right here. Why should it be stuck? Because everything is disjointed. It's not a symmetrical market. All three averages are not moving together. They're not moving in tandem. Stop posting. So I would really want to see it run here above that fair value gap right now in this candle or the very next one. Only because we've had 2 times trading down into that bullish breaker. In my opinion, if that breaker, which is this one over here, this is the up close candle, this highest up close. If it goes back down there one more time, I'm not so confident that that's something that's going to support price anymore. Because did it deliver a response that I would expect in price from here? No. This is just going back up to a premium array, which is this fair value gap. Here, we traded down to it. It's showing the same type of response here, but it has yet to go above that fair value gap. I would want to see this candle or the very next one without going below this low. I would demand it, rather, say it that way. I would demand, you want to hear supply and demand? And there it is. ICT demands price to deliver that specific way. Or I'm going to supply myself a reason to sit still. But that's what you would want. If trading or a trader was a superhero, you would want to know how to avoid doing something where a weakness could be hidden in the price action that you don't necessarily see coming, but you understand that these are the conditions where kryptonite might be in these candlesticks. So therefore, let me tread lightly. I'm not going to rush in there where every Tom, Dick, and Harry, some suicide squad would jump out there and do something, and wreck themselves. That's why it always looks like I'm always right. I never show losses. The reason why I'm sharing that is because I know what I'm looking for. I do lose. I got it wrong a couple times publicly. There's no shame in that. But the reason why I'm most of the time, not always, most of the time accurate is because I'm working within the mindset and the skill sets that I'm trying to convey to you in the long, boring discussions. But you want entries, and you want signals, and you want to copy something, and you want to make money. That's a derivative of doing everything I'm trying to tell you, which is more meaningful. How do you navigate? How do you sit still and do nothing? What are you waiting for? I promise you, if you stay with me long enough, you'll move away from that mindset of just get me into a trade, show me where to buy and sell. And then you'll start having more meaningful questions that will mount up. Like, how do you know when to not take a trade? How do you know when not to consider a fair value gap useful? How do you know when a breaker is going to fail? How do you know? I'm talking about it right here. But it's not sexy because it's not putting you into a trade. It's not chasing money. But this is how you make money. This is how you keep your money. Okay, so here's our second candle. So it needs to get above the fair value gap here. Okay, so we've done nothing except for what we've already done previously with here, here, and here. Okay, so now because I've given you that demand of what I would see price do, we're on a 5-minute chart. I'm going to drop down to a 1-minute chart, okay? Because we've passed above it. And this is the risk that we run. It may just tear off without us. But I'd like to see this candle close and an open of another one and trade down to it and then react off of it that way. And then see if it can reach up in that 4138.75 level, 4140.5. NASDAQ made a higher high. Dow is still sleeping in the mud. Dollar is still meandering a little bit higher. Let's see here. Yeah, see, I don't like that. See what we just did there? All we did was spike through one more time. I would have rather seen it close on that candle and then open a new candle and then trade down. That's what I would have rather seen. But now we're on a 1 minute chart, so we'll watch this here. So if we can get a close above on that one and a new candle opening that trades down to it, we would want to see it support price there and then look for it to expand higher. That's the process, the protocol, how I would utilize that inversion fair value gap. That's not the only way I use it. That's not the only way it can be used, but that's the entry level expectation how to utilize it. Now, if I was extremely bullish, let's play devil's advocate for a moment and say that all three averages, the NASDAQ, the Dow, and ES, were all in agreement moving higher today, and this fair value gap had my attention. I would be going long inside of it, not requiring it to go above it and trade back down and support. Much like you see me sometimes entering in order blocks where I'm annotating saying, okay, this is an order block, but why didn't you wait for it to go above it and come back down? Because that's just another way of using it, which is the reason why I say that most of you that are seeing people utilize my concepts and try to teach them, they're not really teaching them because they don't really know them. So there's buy side at 4136, relative equal highs here. About 8 minutes past 10 o'clock. Look for an immediate rebalance here, which would be like coming down to the top of this candle or just short of it and then run higher. That's what I would expect to see, something like that. Immediate rebalance is my concept when there doesn't require 3 candles to make what would you expect as a fair value gap. Like say this candle stops right here and there would be this gap here. Immediate rebalance is where it opens, comes right back down, touches that candle, and then like rocket fuel takes off. That's fun. That's also something I watch when I'm looking at order flow. Generally, that happens either when everything starts getting in sync or the market is symmetrical and it's so obvious where it wants to go to. Those are those low resistance liquidity run conditions that I'm trying to teach you how to appreciate. Whereas in these conditions, think about what you're feeling today. Even with me talking to you, you want so badly to find something to get in here and do. You want to have some kind of response monetarily, preferably profitable, but you feel like you want to be doing something. Otherwise, it feels like it's wasted time. You won't have that impulse once you fully understand what I'm showing you, the contrast between this type of market environment, which they all have very similar characteristics. The characteristics being a high resistance liquidity run condition. Translate that to a very stubborn, stagnant market condition where, yes, given enough time, it can go somewhere. It might even go to where you think it might go. But do you have the wherewithal to hold through all this choppiness until it gets there? Versus trading in conditions that have no decoupling, meaning that if you're going to be trading stock index futures, the Dow, the NASDAQ, and the E-mini S&P are all moving in tandem, the same direction. And the dollar index is moving the opposite direction. And you have the support of other markets like Forex, individual stocks that you might like that are high volume movers. If all those things agree collectively, then you have the conditions that are ripe for a low resistance liquidity run. Meaning that the market will be much more liquid, fast. It'll run from one PD array to the next with relative ease. It will be almost immediate feedback that you're right on side, in other words, not right about your trade, but right on side. PD arrays, like order blocks, fair value gaps, institutional order flow, entry drills, breakers, in low resistance liquidity run conditions where everything is in agreement. See, this is what you're waiting for. You want to wait for these things to form in price action that leads to low resistance liquidity runs, where the market just quickly, easily, just without any effort at all, and fast, bam, it just takes off and goes right to where you want it to go. That's what professional traders should focus on. Not, well, I got to be out here and do it because I got to push my edge. You dull your edge by doing that. You dull it. You want to be able to pick your shots, know what you're waiting for, and because you know what you're looking for, because you know that you are expecting a specific thing to unfold, you're patient. You're not going to be caught up in the frenzy that an average retail trader would be clamoring to figure out what they're supposed to be doing right now. I got to do something right now. No, you don't. There's your new week opening gap low. And see if we can get to 41.38.75. The consequent encouragement. I'm going to measure that just so you guys can see why I was talking about that level. Taking a fib and dropping it right on that level to here. So 41.38.75. So that's consequent encouragement's midpoint of this old new week opening gap. By itself, we've seen movement from the fair value gap that we wanted to see become an inversion fair value gap, run from here to here. So that's 5 handles by itself. We're just underneath 5 handles. Well, I guess it is 5 handles, isn't it? What's this opening price? 32.25 in the high 35.25. Yeah, so there's 5 handles there. I wouldn't be satisfied unless it went to 41.38.75, but more specifically, I'd like to see it pop up and touch the high end. But minimum threshold would be here. I would like to see that. But now think about what it is I'm showing you and what I'm teaching you. Even in this sloppy, choppy mess, I'm patiently explaining to you what would be expected in price, what we would be waiting for. We're not trying to reach for some kind of indicator to plot something. We're looking for things to occur. You want to draw these things on your chart, folks. Okay? I understand that the flavor is there's your consequent encouragement. Let's see if we can pop the 41.40.5. I know it feels, like you're high tech if you have a button that you can push and all these things just populate on your chart. Unfortunately, if you spend any time with the folks that use those things, and I've seen them, and I understand what they're trying to do, and it's cool in some ways. I'm flattered that they're trying to automate some of the things I've taught, but I'm not a fan of it. I'm old school, and there's your new week opening gap high. So let's run through the NASDAQ and Dow real quick so you can see it. This boring stuff. So there's the consolidation and then rally higher. And then let's go to Dow. So here's a six sister idea. What's resting above here? Buy side. Are we there yet? No. So you can look at how we can utilize something like this here. We could drop down. I'm not going to do it here, but this is where I usually drop down into like a 5-second, 10-second, 15-second chart, and I'll buy a fair value gap, buy side and balance, sell side and efficiency right in here. Now, if I was showing you this time frame and I went in and I bought here, invariably, someone would say, look at him chasing price, not understanding that the context behind it would be, number one, the ES is performing, the NASDAQ is performance. Real quick, let's check that out real quick. NASDAQ, higher, firmer, ES, higher, and Dow. Okay, so trading at 33, 879, let's call it 880. From 880 to the buy side in here. It's at 11 points or so. It's not a lot, but that's a high frequency scalp. That, what I just gave you, is a high frequency trading algorithm. It will look for that displacement among the three averages. For instance, the NASDAQ's been leading to the upside. And this is the part where you write this stuff down, folks. If you're eating bonbons and your slippers are still on, you're just looking out your window, you're wasting your time. High frequency trading algorithms will look for that disparity between the averages. And when there is a buy program, which is what we were outlining this morning, we want to see it have all three averages moving in tandem. They should agree. If it doesn't, that's fine, because it will create this sick sister concept. In other words, one of them is sick. It doesn't have the energy, it doesn't have the strength to perform the same way the leader did, like the NASDAQ. But given enough time, it heals, it gets its strength, and then finally it moves in sympathy. So it runs in favor of what the stronger one has done. So it pulls, the stronger one pulls this one up. It grabs a hold of it by its hair and drags its rear end up, higher with it. So what the algorithm, high frequency trading algorithm, would do is look for that moment where I just outlined to you. There's a disparity. The orders haven't been taken for Dow yet. So a high frequency trading algorithm would go in there on a drop down on 5 or 10 or 15 second intervals, sometimes less than that. They would buy into that inefficiency. And when it happens, you get that. You don't need me to push a button, folks. I'm telling you what's going to happen. So all you got to do is just listen, because this stuff repeats every week, every day, and it will not stop. They can't hide it from you. They cannot hide these things from you, folks. There's no reason to be fearful that it's going to stop working. When the markets are taken away from us entirely and we can't trade, then that's something to worry about. But as long as we have access to trading, these concepts that I've authored and created and presented to the community will continue to work. They won't fall out of favor. They won't become the retail logic, because this is the market. There's always new suckers coming into this industry. Always. Always. And they're always going to buy the same stuff that you've bought, that I've bought, books, courses, listening to people on the internet. And they will always start off on the wrong foot. And because of that very truth, it will repeat. Let's go back to ES. Oh, now it's boring. So now let's take a step back and look at that 5-minute chart, okay? So remember I was telling you about the bullish breaker? We did not want to see it come back down here. We needed to see it in this candle. I said that candle or the next one. It needs to run. Trade up into the low, into the consequent encroachment, into the high, and then went even further. So also think about what I mentioned, I don't know, 20 minutes ago. So this low, I mentioned that was a swing low within the context of what? looking for price to try to catch up with the NASDAQ. Think about what price was showing right here, okay, right in here. And then look at what NASDAQ was doing at that very time right here, this 935 candle. Let's look at NASDAQ. 935, we're up here. So, what's going on here? NASDAQ is tipping its hand. It's saying, we're under accumulation. We're in a buy program. Watch for higher prices. I'm not waiting around. I'll see you when we get there. ES, chopping around, stopping individuals, scaring individuals, worrying individuals, confusing people. And the only thing we're doing is looking at two reference points. What were they? The bullish breaker, which it tapped twice, and the Monday initial fair value gap. Dragged through because we're not supply and demand. I'm sorry, I'm not. If it was something just like that, I could just say, here, just do that, learn that. I would do that. I would save myself a whole lot of time and aggravation and listening to people say things that aren't true. But that consequent encroachment of that gap, it trades right down the midpoint of the high and the low, half point right there. Inside of the order block, accumulation. I told you the timing. It needs to go on this candle or that one. It does. We drop down into a 1 minute chart once it traded above. We opened at it, dug into a little bit, rallied. Fair value gap. The low of that candle here, you're going to look up here, upper left-hand corner. See that right here? The low of that candle comes in at 41.33 even. The high of this candle, 41.33 even. That's perfect. You can't improve upon perfect. I'm sorry, but that's it. I mean, you're looking for that. Okay, when you first started trading, the things about you never losing, never having a losing trade, that's a myth. That's a myth. You're going to have a losing trade, and every trader takes a loss. I take losses. But what keeps me on side is what I'm explaining to you. Now think about how could I have said everything I said this morning shorter? Knowing what I've said here today, what I was looking for, the rules, the reasons why I'd be waiting, what I'm looking for, why I'm expecting it to do this, what am I referring to support the idea, what would negate it, what would nullify it. Now, come up with a way, because you have it now in hindsight, how could you have said everything I said here in less time or in less words? You can't. So that's the reason why these boring discussions and lectures are fruitful for you if you spend the time in them. Most of the questions that you don't even have yet are going to be answered preemptively by simply studying during these parts, okay, these lectures. This is the stuff that I would have had access to, because entry mechanisms, that's easy stuff. That's easy. But knowing why the market should behave a specific way, how not to be caught up on the wrong side, how to trust time, how to trust the ebb and flow of how all these markets work together. You can't just look at one chart, one market, and say, I'm going to be informed and I'm just going to do this. You're not. You could be profitable, yes, but you're only looking at things through a very small scope. And there's a lot of other details and a lot of other supporting features that come by way of looking at other markets and other assets. So when you have this expectation of only looking at one market, don't dilute my attention with something else I might not even be interested in trading. Let me just focus on the market I'm trading. So therefore, I'm really dialed in. No, you're myopically looking at one thing. You're doing one trick pony analysis. And I can tell you, if you're really trying to be good at this and you want to be calm, you want to feel composed, And you want it to be boring, folks. You don't want a rave environment. Okay? We're not running a nightclub here. You want your money making to be boring. You want excitement on the weekends when you're not trading, then spend your money and do whatever you want to do. That's where the excitement comes in. You're enjoying the fruits of your labor. But this is war. You haven't won yet. You don't have your victory. You haven't taken your spoils yet. So there should be no celebrating and dancing while you're at war. You have to have your spear, your sword at your side, and your shield. And you got to be ready to bleed. Because that's what's going to come. And you want to keep that bleeding to a minimum. But you want to do as much damage to the marketplace when it presents its head on your blade. That is low resistance liquidity run trading. Markets transition from high resistance to low resistance. Where does that occur? Where does it occur today? I'll give you a minute to think about while I'm grabbing a drink real quick. Just look at this chart. Tell me, where does high resistance transition to low resistance? What time of day do we focus on? What's the flavor for April's teaching? The silver bullet. So it's a time-specific window of opportunity that the algorithm will present to traders that are aware, that are looking for it. You just can't go out there and say, oh, here's a fair value gap, so let's look at that and trade it. No. This is the reason why I get ticked off and I go on rants. And I offend a lot of you 20-year-olds that want to copy me because you want to teach. You want to get clout that way. Here's how you get clout. Learn how to do it, trade, and go out there and show that you can do it live and trade and know what it's going to do beforehand. You will get the clout that you really want. Teaching it, anybody can take what I've already said and use a hindsight chart or market replay and look smart. I don't want my students doing that. I don't want any of my students doing that because anybody can do that. If you can call the market because you've understood how I've taught it to you and you understand how the market's going to behave, then that's wonderful. I'm in support of that. But I want you to think about how, for instance, the fair value gap. That's the context or the multiplier used in the silver bullet trade. So let's walk through real time, in context, everything I outlined here, and it's all in the recording. I can't change it. And there's thousands of you that are sitting here watching me describe it live. Were we talking about the market going down for ES? No. What was the bias? Higher. What was I calling for as a target? 41.38 3/4 and maybe 41.40 1/2. So my bias intraday for the AM session was bullish. It was not 50-50. It was not, it's going to probably go down here, and here's where it's going to go. I was drawing your attention to that new week opening gap right there at 41.37 1/2, and even rather, and 41.40 1/2. In between was consequent encouragement, which is 41.38.75. While it was meandering around here, going sideways, I referred to that initial fair value gap on Monday, explaining how it's drawn through the entire week, much like I teach the opening price on Sunday. If you drag that through all of the week, it will treat it as fair value. It's also helpful for trading positions, long-term positions, because you can, if you're looking to be long, you want to ideally try to get something long below that opening price that opens on Sunday. It matters not how deep below, but your best case long-term swing trading, in other words, like trades that go longer than 2 weeks into months, if you will, they are better entered if you're bullish below the opening price on Sunday, or if you're bearish above the opening price on Sunday. It's not limited to that, but the best, if you go back and look at your old moves and such on a longer time frame, you'll see that's true. It's not just a form-fitted thing. I've said this in core content too. But I drew out your attention to the bullish breaker, which is the blue shaded area here, but we'll go to a 5-minute chart because that's where it started from. So here's your bullish breaker. And I mentioned this Monday fair value gap. Is it hard to see how we've accumulated in both those areas? It's hindsight now. You can see it clearly. But you being told real time at the time to focus there. Did it do what we were looking for? Yes. Did it run finally through the fair value gap that we were sitting behind waiting for it to give way? Yes, it did. Did it do it in the candles I told you it would do it on? Yes. Did it run to the low of the new week opening gap? Yes. Did it run for the buy side above here? Yes. Did it go to 41.38 and 3/4? Yes. Did it go to 41.40 and a half? Yes. Was there 5 handles to that move? Yes. Where did the market transition from high resistance liquidity to low resistance liquidity runs? Let's go back down to 1. You're waiting patiently. You're not retail. You might trade with a retail broker, but under my tutelage, you are not retail minded. You're not. You're not learning to do what retail traders do. You're not falling victim to the things they fall victim to. You're relaxing. You're letting price give it to you on a silver platter right there. What do you see? That fair value gap I mentioned. Right there. That is your silver bullet. Where's the draw on liquidity? This high. But if it's going to go above this high, Michael, where can it go? Well, that's what I have the new week opening gap there for. So what level above this high exists? The initial one right above that high would be what? Consequent encroachment, which is the midpoint between the high of the old new week opening gap and the low of this new week opening gap. So above this high, the level was 4138.75, which is midpoint or 50% on a fib if you drop it down over top of those levels like I did earlier. That gives you the target above buy side. So if you're buying inside the fair value gap here, and we'll just do a worst case scenario, so we'll do like the midpoint, 41.33 and a half, so 41.33 and 3/4. There's 5 handles. 41.38 and 3/4, that's 5 handles. That's the silver bullet. And you don't even need to get to the high of the new week opening gap. And you don't get all this fluffy cream on top if you left a runner. So, while all this choppiness was going on, for your notes, this is called time distortion. This right here is what makes people say time-based charts are useless, because they have no idea how to use time. I just showed you today. The time bender. So the context was we've already went from this fair value gap over here. Let's go back up to a 5-minute chart. So the fair value gap here. Do you like doing this, folks? Give me a thumbs up on the video if you like learning like this. If you're inspired by this, seeing it live and watching how it paints, give me a thumbs up. I'd appreciate that. It's an encouragement to me. I promise you it doesn't make me any more money on ad revenue because I got videos that have a lot of thumbs up and it didn't do anything more than the videos that I don't have much thumbs up on. It's just a marker for me to see that you're paying attention and that you appreciate me doing this because I don't have to do it. But that fair value gap, we had... lost my train of thought. Not sure what I was going to say there now. Let me go back to the 1-minute chart. It'll probably jog my memory. Yeah, time distortion. So all of these candles in here, this is time distortion. But if we go back to the 5-minute chart where everything originated from, Our frame of mind and focus was, yes, we have this fair value gap. Yes, it dropped down into a discount as we would expect it to do, into a bullish breaker, which is a discount array. How far could it go down to the low of that candle right here? Right here, this candle at 710. Why isn't this the breaker? Because the body of the candle of this one is higher than the body of that candle. Even though this high here, I don't care about that. The volume inside that candle dictated that it would be closing here. The wicks do the damage. The bodies tell the story. You can't just go, well, this looks like a breaker. No. You have to grab the right range. And I'm giving you and teaching you and have already taught how to identify the specific order block. How you use these order blocks, that's experience. You have to be mentored by me. You have to see me doing it. You just can't say every down closed candle is an order block. It's just like I'm going to show you every fair value gap isn't something to be traded. You have to have an understanding of narrative. Narrative is, in the simplest way of explaining it, it would be knowing what the algorithm will do based on its source coding. Not that this is what a pattern should show. It's what's the algorithm going to do, and why should it, and when should you expect it to happen? Now, I'm going to say that again, and before I complete this video today with you, think about what I just told you to think in terms of what narrative is. This is what you write in your notes. Narrative is the understanding of what the algorithm will do next, why it will do so, and when it will do it. Those are three questions that if you were to do a poll publicly, even if you asked people that call themselves market makers, desk traders. I used to work in the city, and I was working at a prop firm, and I was doing this, and I was doing that. Do this. Call it like this. Because those individuals aren't going to believe that there is this much level of manipulation and control. They think this is all buying and selling pressure. And the question is, that I always pose, how can random buying and selling pressure present the level of precision that I'm showing you exists at the time I'm telling you to anticipate it? It takes more faith to believe that garbage than it does to see the proof and evidence I'm presenting every time I sit down with you. So narrative is the understanding of what the algorithm is going to do in price next, why it should do it, and when will it do it. I walked you through it today, like I've done many times, but I want to go into greater detail here and close this one and bid you all a good weekend. When we had this consolidation in here, I drew your attention to the fair value gap here. I told you that the initial fair value gap on Monday, that was one of interest for me, and I told you I'd drag that out, much like a Sunday opening price. Just like I teach on an intraday daily basis, the opening price at midnight. You can utilize that for power 3 concepts when you're buying below it, when you're bullish, selling short above it when you're bearish. It's a really nice filter. It doesn't mean you can't take shorts or longs that would not be in agreement with that idea. It just means that that's the best of the best. And if you're really trying to be disciplined and you're willing to let a lot of trades go by, but you just really want the best ones, and you want to have like the record that I'm showing you publicly because everybody's asked for a track record. My track record is what you see. I'm accurate. When I call it, it works. When I whistle for it, it comes. That's the track record. I'm bringing it publicly. You don't need me to push a button. You already know how to do that part of it. What you don't know is what I'm showing you here live. That's mentoring. Showing you what's going to happen in price before it happens, and then it does it. It encourages you. It shows you that the concepts are indeed valid, and it shows and proves authorship. So let's go into those 3 questions here with this morning and kind of like solidify this as a lecture that you can be thankful that you were part of. The initial opening range I mentioned here, that was providing us initial resistance on the idea that we would see ES get in sync with what the NASDAQ was doing. So go back and think about what I was suggesting about the dollar. I wanted to see it go weak, go lower, but it could. Here's one of those if-then statements in logic. If the dollar goes lower, ES can go higher easily. However, if that doesn't occur, then we find that the dollar consolidates, which is what I said in the recording. Go back and listen to it. It can consolidate. Well, the dollar's been consolidating. Don't believe me? Let's take a look at it. Yes, we went up here, but it's inside that range high and that range low. So we're doing what? We're just going sideways. So a consolidating dollar is not equivalent to a lower dollar where we would expect higher prices in ES, but we would not want to go long in ES if this was raging higher and traded outside of its dealing range high. That's not what we want to see, but we haven't seen that yet, so it's all consolidation. Now, let's ring in indicators, okay? There's a couple companies out there, a couple individuals out there making indicators for TradingView and other platforms. And don't get me wrong, I love the publicity because it's getting people knowing more about me, and they can find the channel and they can learn how to trade for free and not have to worry about paying anybody to do it or pay a ripoff that's been taking my content and rebranding it. The indicators would plot these little areas here as fair value gaps. That's not what it is. This is not a fair value gap that you could utilize for that purpose. If you go back in the recording, you can hear me right down here. I said, I don't want to see it turn here. Because not that it can't go up here and treat that as a sell side imbalance, buy side efficiency, or a premium fair value gap to go short and expect lower prices. It's already done 3 stages. A low that went below this one over here. This low went below that one. Now this low was here. Go back and listen to the recording. During this time, I'm saying I don't want to see it turn here. So if it starts to turn here, it's going to do what? It's going to trade back up into these areas here where anybody just watching one ICT video or learning from somebody else with a dollar mentorship, rebranding my stuff, they're going to say, oh, this is a short. This is a bearish order block. It's not. Because the narrative is stating that the dollar has already done 3 stages of runs on sell side. It's not technically a 3 drives pattern, but from a narrative stance, it's already taken 3 pools of liquidity for sell side. So what is it likely to do next? Consolidate or run for buy side? Where is it going to consolidate if it's going to consolidate? Here and here. What has it done? Consolidated. If it runs higher, where's the buy side? Right above here. Okay? So that is hard to teach in a tweet. It's hard to talk about in hindsight for you to see, oh, that makes sense. Because it's going to seem like it's form-fitted and cherry-picked. But I gave you all that insight. Go back and listen to this again. Right down here, I said, I don't want to see it turn, but it can consolidate. Consolidation in a dollar is much like what I teach when I'm teaching Forex. A dollar index can be consolidated, and when it is consolidating, what that does in Forex, it allows the cross pairs, the non-dollar based currency pairs, to move. Versus like when dollars moving freely, higher or lower, that's directional for euro dollar, pound dollar, Aussie dollar. But if the dollar is held in consolidation, like we're seeing here, what happens is you'll end up seeing like euro pound will be permitted to trade wider than it normally would. You'll see a difference between cable and euro. If you look at the difference between them two now, cable is a little bit weaker on the downside, and euro dollar didn't go. Well, just show it. I'm going to teach it, right? So let's show it. So here's a euro dollar on a 5-minute chart. I know some of you are here just for ES, but trust me, this is teaching what you need to know. So here's the euro dollar. Okay, it's consolidating with the dollar. Pound dollar, much more animated. Even though it's sloppy and sideways, a lot more animation to the downside. What do you think is going to happen when we load up the euro-pound currency pair? What direction would it be? And would it be stagnant price action? Would it be consolidating like we've seen euro and dollar? Or would it have a little bit more wider range or displacement? Oh, look at that. So euro dollar was consolidating while dollar was consolidating, and cable was decidedly lower, more animation to the downside, giving way to a firmer euro pound. So the trend is going to exist or materialize in this pair because it's not rooted or founded on a dollar. So the allowance for the algorithm moves and shifts to this pair while they're holding dollar. Euro is heavily weighted with dollar, so it takes a lot for it to not be consolidating with it. But the times that it does break out, that would cause euro pound to drop. But it's consolidating with dollar while cable drops. Cable is pound dollar. So that is the equivalent to saying that this is going to go up as a trend. So you want to find big trending days or big trending model days in crosses that are not dollar based. I just taught you this. This is taught in the core content. Okay, this is ICT 101. Okay, and this stuff is gold. It teaches you. You're not surprised. Okay, like you're hearing me talk about all this stuff live, and you don't ever hear me saying, oh, "Man, where'd that come from?" And that's exactly what you want in your analysis. You want to see this stuff coming. You don't want to be surprised by anything. When you're surprised, that's something like a black swan event. And I'm surprised by that. That type of stuff. I'm like, whoa, that was a lot more than I was expecting. Or where did that come from? Well, somebody just dropped a device that causes a lot of carnage somewhere, or some kind of geopolitical event, or some kind of unpredicted or unforeseen event unfolding. Think September 11th, in the United States, something like that, a Pearl Harbor event, that type of thing. Nobody can know for certain that's going to happen, and when it does, it sends shockwaves through the markets, and then boom, you're going to take a loss. That's the risks, okay? But now let's go back to ES. Some of you Forex traders like, yes, he's talking about Forex. Woohoo! It ain't time for me to talk about Forex yet. All right, so let's go back to the context where we were looking at all this in here. Now, this is time distortion. Okay, all these candles is bouncing around in that little range like that. That's time distortion. The way you clean all that up, and how I use time-based charts, and how the algorithm itself will refer to time, you want to use a time-based chart because that's the best way to see algorithmic price delivery. I don't care what anybody says about Renko bars and all kinds of other crap, okay? All that stuff is hiding what I'm going to show you. So if you want to be hidden from understanding why price is going to do it, when it's going to do it, keep using anything outside of a time-based chart. Keep doing that, okay? I promise you this information, this insight will constantly elude you. And you're happy, go run around, make videos and say I'm a fraud and it doesn't work. I don't care. I'm laughing. My students are laughing at these jokers that do that because we're proving every day, every week that it's there. It's rooted in sound logic that can't be argued. It's there. If it wasn't, I couldn't do what I'm doing, right? Think about it. I'd be falling on my face every time I come out here, and it's not happening, is it? So these are the receipts. This is the proof. This is the evidence. So go back inside this range. What range? This high to that low. Why am I picking that high? It's an up-close candle. Why am I not picking that one? That's an up-close candle because this candle's high is higher than that one. It's also having a candle that's lower in its high to the left of it. So this makes this what? A swing high. So that high down to this bullish breaker, that passed through one time, that is your dealing range. Okay, this is your dealing range. This is the part that people pay me for this information, okay? So if you're going to sleep, start yourself up because this is what people want to see. So there's your dealing range right there. Right inside that little, let's lighten that up. It's a little too bold. Okay, so there's your dealing range. Inside that dealing range, I don't care how much time it spends inside of it. I don't care. I'm waiting for something to occur. What was that? Everything I outlined this morning. Does it support price going higher at the breaker? Yes. It goes back down one more time. Does it go outside that range? No. So the dealing range is not disrupted. It only went down there one more time. But inside that range, with all these candles, I am not worrying about this. Okay? I'm not impatient. You heard me. I'm waiting for what? I'm waiting for the movement above that fair value gap. Inside of this dealing range. And it's in the premium side of that range. It's in the upper portion of it, upper half of it. My expectation was we were going to reach for higher prices this morning. I outlined it. It's all in here. 4138.75 was my specific target because it would take us above this high here. That's where buy side is. So where specifically am I aiming for? Because I'm not doing a supply and demand zone. I'm telling you specific price levels. I'm going to submit to time while it's doing all this chopping around until it does what I want to see it do, right back to that fair value gap. Once it trades above that and takes out these highs, go back and watch the recording because that's when I transition down to a 1 minute chart. At that time, all through here, I'm going to extend it a little bit further because this is where our range is. And then we crossed over the fair value gap. So I'm encapsulating in this little orange box this up close candle that took us above these highs and above that fair value gap. So dropping down to a 1 minute chart. And you thought it was just moving averages, right? Oh, like ICT, you can trade with moving average. Yes, you can. I used to do stuff like that. But I didn't know what I was doing. And I didn't know what I know now. And I would never do that again. So here's your dealing range. So inside of this high and inside of this low, I'm not concerned of how many candles it makes going sideways until we get above. When we get above, take out these highs here. What is that technically becoming? A shift in market structure. We've already shown 2 times where it worked off of that bullish breaker, that blue shaded area down here. And I told you that the candles that it needs to now deliver. Otherwise, it's not good. And it would probably go deeper than the bullish breaker. And my analysis would be incorrect. And I would just have to wait for something else to do. So I gave you all the parameters, everything. I told you what would nullify the idea. I told you what we were specifically waiting for, what the criteria was, where the accumulation would take place inside the bullish breaker and inside of the initial fair value gap on Monday. That's this green area. Does it accumulate in here? Yes. Does it send price above that fair value gap that I had on the 5 minute chart when I expected it to do it? Yes. It came in, opened, traded down into it again a little bit, and then rallied. Then created the fair value gap I drew your attention to real time right then and there. I said that if this candle here, I would like to see it trade down and give it an immediate rebalance because this would otherwise be a fair value gap. Right when that forms, what are you waiting for? What time of day are you waiting for in the morning session? Between 10 o'clock and 11. Folks, you can set your business hours to what I'm teaching. You don't see that in other people's stuff. I mean, you're learning it now because they're learning from me. But these ideas have always been rooted in algorithmic delivery. As soon as we went to electronic trading, you think they just electronically allow you to just randomly push price around? You honestly believe, listen, pay attention. You believe that they're going to allow us, the collective, to muscle these markets into a crashing scenario? You really think that's going to happen? No way. No way. That's a religion if you believe that. I'm not religious. You're looking at control. It's always controlled. And that should not be fearful. You shouldn't be fearful of it either. You shouldn't be fighting against it, saying it doesn't exist. You just accept the fact that it's there. And it's advantageous for you to identify it as such. Because once you subscribe to that view, which is the truth, it removes all the things that you wrestle with as a trader. I'm impatient. I don't know what I'm looking for. When will these trades form? What does it look like? How often is it? Is it profitable? Where can I place my stop loss? Where's my targets at? All of those answers are given to you if you just listen to me. But you're worried about when it's going to stop working. At ICT, you got so many students now. It's going to stop working. I guarantee you it won't. I bet you $1 million it won't. It'll still be working when I'm gone. So why are you wasting time? Just learn it. You're seeing that it works. You see students that are making money with it, not chump change money. So in between 10 o'clock and 11, we're talking about 60 minutes, folks. 60 minutes. You got a job? I know, it sucks. Be thankful that you have it. You're running a business that's time-consuming and distracting? I understand, but be thankful that you have it. You sleep during this time, ICT. I can't wake up. Use an alarm clock. Because you're going to have to make some kind of sacrifice, folks. Somewhere in your life, you're going to have to give up something to the market. It's a cruel lever, and it demands all of your attention. It demands all of your energy. And if you let it take all of it from you, it'll be a vampire and suck everything out of you. Life, time, hope. And you'll fall in love with it more than your family, like it did with me. This removes that. It's very specific, time-based. Silver bullet. You want a one-shot, one-kill, silver bullet idea. Give it to me, ICT. Oh, here it is. Repeats, 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 repeats. But how does it work? You have to understand the narrative. And that's why I said all those PD arrays that I taught in core content that were being tossed around on Telegram and Discord channels and websites for sale, and they're still trying to sell it when you can get it right for free or on my YouTube channel. Clowns. And I'm out here teaching it to you live in a live stream, just like I was doing with paid mentorship students. Walking through, and some of them looking for signals, they would get upset, impatient, say, this is not what I wanted to do. You don't want to learn how to trade, is that what you're saying? Because that's exactly what you're saying. You got to learn how to see these things form before they're in the chart. What are these repeating characteristics? Let's walk through it. Time, okay? What is the price going to do algorithmically next? What's the algorithm going to do next? Well, we were walking down here. I said, okay, we went down to that bullish breaker one more time. It should deliver above that fair value gap. I told you that. Within 2 candles, it should start running. So it should go higher and then start reaching for the buy side over here and into that 4138.75 level and in the high of the old new week opening gap. So that's me telling you what I believe that the algorithm is going to do next. So that's in this recording. You'll see it. It's there. It wasn't ambiguous. It wasn't flip-floppy. It wasn't wishy-washy. It was exactly what I said. Why should it do it? That was the other question, because this is narrative, okay? Well, because we've already went down to the low of that dealing range from that high to that low. We did not break it. And it's approaching what time? 10 o'clock. So you forgot about time. I didn't. I'm aware constantly. I don't have to have these lines on my chart, but you should while you're learning. You should have these reference points highlighted in time on your chart because it'll keep your eyes focused on what it is you're looking for. Now, think about it like this. If you're looking at charts like this, okay, inside of this vertical line and this side of this vertical line here, we have one portion of price action that keeps your focus dialed in. You don't care so much about what it did before. You're forced to look at what is it going to do in between these two lines. Well, I told you. We're going to draw up. Told you the very candles it's going to key off of. Told you what time it start running. Why should it start running there? Because at 10 o'clock to 11 o'clock, that macro that runs, once there's an imbalance that's formed, I took your attention to it right there. I would rather have seen immediately this run here and then take off. That's what I wanted to see, because that's what I'm looking for in low resistance liquidity run signatures. That I love that pattern. I love it because it tells me it was going to go much higher than it has. But because it didn't, this is the part where you write down what I'm saying, folks. This is good. It's good stuff. Try not to say any bad words. I've been doing good since Passover, by the way. If it would have created an immediate rebalance, in other words, let me take this off. I'll put it back on in a second. If this candle, when we were talking about it live, I said I would like to see it trade down and touch that candle's high. That would be an immediate rebalance. If that occurred, we would be above 41.80. Because it created the fair value gap. In other words, it closed here and kept that low here and that candle's high here. That started the fair value gap. Then it becomes a simple silver bullet trade. Then you got to revert back to just, okay, where was your targets? And there it is. And be done. And be content with that for the morning session. I'll teach you more about immediate rebalance and how the effects of seeing those form and how it supercharges price action runs. Right now, I'm just putting it out there because that way you have a section in your notebook where you have now been introduced to it, even though I talked about it in the lessons. That fair value gap is the fair value gap that forms once we had these highs taken out, once we traded above this fair value gap. That was the minimum threshold that has to trade above to act as what? Inversion fair value gap. So for the indicators that are presenting this, there's a fair value gap right there. There's an order block right there. So if we trade down to that, wow, we got ourselves an ICT indicator. Well, by golly, we got something. Everybody wants that. Nobody wants that. Nobody wants this, okay? This is flawed logic. It's lacking narrative, and that's why the indicators will not be doing you a favor. I'm sorry, but you want a Lux life, you got to do it the way ICT teaches it, okay? It doesn't come by an indicator that just plots simple stuff. Simple stuff, okay, doesn't equate to blue ribbon results. And if you're a coder and you're doing this stuff, I'm not trying to be ignorant to you. I'm not trying to be disrespectful. I'm just reminding you that you're doing something and presenting something, albeit interesting. I mean, I love seeing how people are trying to, automate the things I'm teaching, but it's not correct. It's not correct. It's not complete. So there's a lot of things that, why ain't this a fair value gap? Because the narrative was we had to go above that older fair value gap here and trade above, which cancels out the premium idea on a short basis. Because if it can trade through that, what is it doing? It's disregarding, it's disrespecting what would otherwise be a selling area. And how many times did we trade up into that? Multiple times. So it's warning it out. It's telegraphing it to you that this is not an area to go short on. So what are we looking for? A run above here and above that fair value gap. Then rally between 10 o'clock and 11 o'clock. When, for narrative, when does this form? Between 10 o'clock and 11 o'clock. It can't be this as a fair value gap because it's below what we were requiring to be broken to the upside. So we can't look at that as a fair value gap. That's not even a fair value gap. It's a balanced price range. We have a fair value gap here, and we have one here. This is all balanced. So there's no need for it to go back down there. See, that's the part you don't know. And that's why you shouldn't be trying to teach my stuff. Fair value gap, silver bullet. The difference between it, if it would have been an immediate rebalance, there probably wouldn't have been a silver bullet trade for this indice, and then we would have been rocketing higher to 41.80. But because we had a fair value gap form traditionally, then it's just retrade down to it perfectly to this candle's high, to the tick, here, and off to the races it goes. So narrative is the most important thing, not market structure. Okay, market structure, you hear people, your trading requires, in essence, your understanding of market structure, because market structure is everything you're looking for. No, it's not. It's one facet, one piece, one little cog in the machine. It's useful, don't get me wrong, but narrative is where it's at. Why should it rally here? But Michael, why didn't it go down here for these relative equal lows? Because it doesn't need to. It was going down here to pick up discount pricing. Going down here to pick up discounting price. Goes above a premium array as we would expect. We don't look at this as a selling opportunity because it's already shown us what? It's not likely to do that. We were not falling victim to this as a short either. We didn't look at that as a selling opportunity. I said, we're waiting. What are we waiting for? Everything I outlined this morning. And then, boom, the little unicorn right here. The thing that some people say that doesn't exist. You can't time the market. You can't time the market? You will if you stay hanging around with me, you will. You can't time the market, ICT. Nobody can do that. Oh, my middle name's Nobody. And your name's going to be Nobody soon, too. Folks, you can do this. The logic has already been taught to you, and I'm proving it by doing these live streams. I'm not really teaching all that more than if you've been listening to what I've said in the lectures where it's really long and drawn out, because I've already talked about all this stuff before, with the exception of the immediate rebounds and the difference between that and the fair value gap and how it supercharges price delivery. That's kind of new. Even charter members don't know that. But I don't know. I mean, was this helpful for you this morning? I'm certain there's going to be a number of you that don't find any value in this because it's me doing it. So I could literally give you the winning lottery numbers tomorrow and it could win and you'd still find fault in what I'm doing. That's cool. I get it. But, for the folks that are really here trying to learn, I believe, this is not some biased opinion because it's me saying it, but I believe that learning this way is the highest form of mentoring, because I'm not enticing you to take on risk or try to pursue profits, but rather understand what it is that you should be doing and anticipating in price. See, because we're not reacting to price. Your job is to anticipate price, not react to it. A retail trader will say your job is to react to price. It's not to predict the future. That is nonsense, because if you're taking any risk ever, and you're putting a position on, and you're putting a stop loss, and you're putting a target for it to reach to, you're trying to predict the future. You might not want to call it that because it's, a guess. We don't guess. We do technical science. Okay, that's what we have here, technical science. You're all part of the Hogwarts now, School of Wizardry. And whether you like it or not, these things are going to continue. The level of precision is going to continue. It's not going to stop. If anything, it's going to get better. As the systems that these markets run on improve with speed, and hey, technology only does one thing: speeds things up. So that means we're going to have a whole lot more setups. There'll be more opportunities, not less. They can't hide it from you. If I could answer one question and settle everybody's mind at ease, the most requested question I get by email, direct messages on TradingView, which I rarely ever, I've probably done maybe 6 or 8 responses on TradingView. I don't respond. It's not because I don't like you. It's not because I put you on ignore. I just don't do it, because I know as soon as I do one time, they think that's a text message venue where they can send me 1,000 things, and I don't have time to do that. There's so many of you that already know my phone number, and you're constantly texting me. It's like, it's too much. You're encroaching on my personal life, and I'm a person. And it's not because I don't want to talk to you or help you. It's just I don't have that time to do that. So when I'm talking to you like this is your time to listen to me. Okay? If you want to send me a message or whatever, send it on Twitter. I'll see it, I promise. But I don't know what I was going to say again.
can recall back, because I wasn't talking about a chart on a specific time frame. So I feel like I've lost that one. I don't know. I don't know what I was going to say there. I'm sure it was probably good. If I remembered, I'll send it as a tweet. But I think that this is a highest form of learning. You know, explaining what should take place in price action, why it should happen. Why shouldn't it go down there and take out those stops, Michael? Because it went lower when we were bullish. NASDAQ was showing us that it wants to go higher. Even though initially the market was decoupled and the averages were not in agreement, meaning that the Dow was going lower, NASDAQ was screaming higher, and ES was doing this. Since I'm forcing myself to work with one market just to show you that, yes, there's going to be, I didn't see the price run for NASDAQ. I didn't call any of that out. But I utilized NASDAQ today in my analysis. I don't ever trade the Dow, but I use the Dow as a part of my analysis. I don't trade the dollar, but I utilize it a lot in my Forex analysis. You have to. But even if the dollar's going sideways, that is telling you something. It's telling you to go into the crosses that don't have dollar in them, and you're going to see the bigger moves there. But when the dollar is moving, it's rare that you're going to see the non-dollar based crosses move. They can, but they're going to be limited. They won't have as much freedom as they will when they hold dollar, which is the reason why they do that. That's a control mechanism. It's all part of allowing the Forex pairs to move around and gyrate. So it's not always, let's go in here and look for a setup. No, let's look in here and see, are they holding anything? If they're holding something, that tells you something else to do. And again, it's not taught in books where you just go in here and find this indicator setting. And this indicator that plots this and plots that. You know, I gave you indications here that just because there it looks like a fair value gap there doesn't mean it's something that you should be trading, which is the reason why I teach my students to draw them by hand. It doesn't take that much time, folks. That's this pure laziness if you don't want to do that. And yes, I'm old school. I prefer the high touch versus the high tech. That's just me. My opinion is, and why I think it's superior to do it manually, is because you're putting thought behind why you are annotating your chart at that price point. And I'm showing you the benefits of knowing the logic I'm teaching you by having it in the chart right here. You can see it. You can see it. You understand why you're putting that vertical line there, because you want to frame your reference and study within that 60 minutes. 60 minutes, folks. Remember when you first sat down and came up with the idea that you want to do what that other guy did on social media, or one of your buddies just did something in a demo account, and you started thinking, wow, if I could do that with real money, I could probably do well in life. And you started to pursue learning how to do this and trade. Not necessarily me, but just trading in general. Contrast that initial moment when you first sat down and decided you want to venture into this. What you knew about it and what you believed was possible. Now, I'm telling you that you can time the market within 10 o'clock and 11 o'clock. Every day. Every day this forms. Every single day. And you were worried about when you first got into it, how do I buy? Where do I buy? You know, when's the next big move happening? Those are questions that you never found answers to. That's why you jumped around from person to person, influencer to influencer, system chasing, and not being consistent. I am removing any excuse for you not to be disciplined, organized, and know exactly what you're doing. There is nothing better than this. This is the elite, superior, apex version of analysis. There is absolutely nothing better than this. This is the market. You look at indicators, you're looking at math being applied to something that's already happened. I don't look at volume because it's already happened. I already tell you where your low volume nodes are going to be. volume profile guys. I'm already predicting where that's going to be. You have to wait for your profile to plot that stuff. Your point of control, all that stuff. That's all hindsight. It's all hindsight. That has no bearing on what these markets are going to do. It might sometimes line up and it agrees with a fluctuation in price here and there, but that's you ascribing a belief-based system of perception on price when price has no appreciation for that very thing. I promise you it doesn't work like that. It doesn't. There's going to be people out there that can find flipping a quarter profitable. And they'll say, look at this system here. Every time I flip it 5 times, it goes heads up. It's going to be tails the next one. And I've been 87% profitable. And you're full of mess, ICT. You don't know what you're talking about because of that. Okay. If you beat and torture the data long enough, it'll submit to anything you want it to. But you can't do this and say it's manipulating data because I'm calling the ticks, the minute candles, live. I have no room for error. I have no safety net. My stuff either works or it fails. What do you see happening? Do you see failed logic here? Do you see flawed logic? Do you see a fraud con artist pulling a fast one over top of you right here? Every single time I come out here, whether it be on Twitter or here, I'm giving you all the reasons why you should just trust this process. It's not costing you any money. And I'm proving that it works. Well, think about it. If I was selling something to you, wouldn't you demand me doing this anyway, right? You would be demanding I do it. If you were that way, you could come out here and show it works real time. He'll never do live streaming. I'm doing it. Why are you still on the fence? Why are you still doubting? Because it's something inside of you. It's not my concepts. It's not the market. It's you. It's always going to be you. It goes on both sides of the coin. When you make your money and your success, you did it. I didn't do that for you. You did it. You pushed the button to get in those trades, but you have to be responsible. When you lose, when you mess it up, ICT didn't push that button for you. You did. And you have to own that. The good and the bad is yours. The only thing I'm presenting is the logic that these things tend to repeat. And in the context of that consistency, you'll find your unique model. Just because it forms every single day, you might favor, hey, you know what? What's a good way? This is the part where you write down this in your notebook, by the way. What's a good way to really filter out this idea? How can we really supercharge it and make it even better than this? Okay, let's think about it like this. In better market conditions, not that we have here, because this is a very challenging market condition for me. And it may not feel that way because I'm calling out the stuff live and it walks like a dog on a leash with me. That is just because you don't know much. But me calling that, I already know that it's going to probably deliver much lower grade of price delivery than I would expect in other times, where we're in a much faster market, more loose, where the market just moves around a little bit more. And I'm not referring to a specific trend. I'm not talking about trend at all. I'm just talking about how much it can move around because they're holding it back. Even though this is a really respectable amount of range, it's still being held back. It's being controlled within that daily range. Let me take you to the daily chart real quick. That's not what I wanted to do. And the daily. See this consolidation we're in right here? Once we leave this little area up here, okay, I'll highlight it again. While we're in this, until we leave this, and I don't care which direction we go, I would prefer we go up here, as I mentioned in the analysis video the other day on YouTube. But until we leave this consolidation, we are in a scalping market. And if you try to swing trade or long-term position trade, you're probably going to get stopped out. You're probably going to be frustrated, and that's because you don't know what you're looking at in terms of the market profile, not the market profile that you think I'm talking about. Like, I'm not looking at histograms of volume posted in my chart vertically. I'm talking about the profile, or think of it like a roadmap. How price should behave or deliver. Okay. This profile that we're in right now is a range-bound consolidation. I prefer it trade higher. That's what I want to see happen. My will has no part of what the market's going to do. So while my analysis is favoring that, I'm not against going short if it presents it, but I'd like to see it leave to the upside, this range here. Until we leave this range, we will be in these small little choppy intraday range-bound consolidations. And you need to be very nimble, meaning that you don't marry any trade and turn it into a long-term position. Don't do that, because it can be very frustrating to be in a nice, fat, profitable trade thinking, yeah, I'm not going to take any partials here because it's going to go to my longer-term weekly or monthly chart objective, only to see it come back and knock you out of it with a loss or scare you out of it with a small little fraction of what you had in open unrealized profit. You collapsed it with a smaller profit. And it's very, very deflating. And you're going to have that. There's no way of really avoiding it, because in the beginning, you're going to try all the things you shouldn't do. You're going to do it, okay? But you have to learn quickly from them if you make that mistake, not to do those again. The smarter, more apt pupil will listen to me and tell you these are the pitfalls. Don't go into there in that setting and do those things I hurt myself with. So you want to be the best student. Listen to me and avoid the things I tell you to avoid. Do the things I tell you to do. And trust the process, submit the time, and it will do its work on you. You will be in the upper echelon of my student base. And it's a very small group, because most of them want to go through the same stuff I went through like it's a badge of honor. Yeah, man, I blew my account and had to go through this crazy drawdown, and I did all these wrong things. You said not to do this, but I did it anyway. Okay. I'm not proud of that. You shouldn't be proud of that. It's not something that you should aspire to do. I mean, I'm telling you the things to avoid and telling you to do the certain things that will avoid doing those things by default. I'm doing that so that way you don't fall victim to that and make your learning curve much longer than it needs to be. You're going to make it longer, not me. But we answered the equation of narrative. What is it? It's knowing what the algorithm is going to do next. Why it should do it. There's no need for it to go down here below these relative equal lows when we're going up against bullishness. It's failed to go lower on that fair value gap that we were watching this morning. So inside of all these individual candles, I'm ignoring all these candles until we get into that breaker. Because if we get in that breaker and we go below that low, we've now traded outside of the dealing range of that high and that low. And that is something I have to now measure. Do we view it as a run on stops that rejects and goes back above here, or does it accelerate down? If it accelerated down and then treated this breaker as a inversion level, then I would have to abandon the idea of initial bullishness and wait for more information. That's not reacting to price. It's anticipating what I want to see in price and what I would be engaging with, willing to assume risk on, and the other side of the coin that is not saying, here, I'm right if it does this, and I always got an out to say I'm right. No, I'm showing you what negates what I would rather do, and this is what it would do in price action for me not to take a trade, but this is what would likely unfold if it did. In shorter, plain terms, it's knowing what you want to trade on, but also identifying if that's not going to pan out, what it's likely to do if it's not going to do that, but you're not willing to trade on that. That's not a 50-50, I'm always right. That's something, I favor one side of the marketplace. Whenever I give an opinion, whenever I sit down with my students, whenever I'm doing something live in the marketplace, I always tell you what I think. This is the side of the marketplace I favor. Even in climates and trading days where I would not trade, like against FOMC, against the CPI number. I was lucky yesterday, everything panned out like I said, but that's not to be viewed as skill. It just so happens that it delivered it right then. But most of the times on CPI, I'm not right. So how's that work for you? Okay, I'm being honest and I'm telling you, I know where my limitations are. If I was always writing CPI, I'd be ahead of it all the time. But because I have hurt myself with real money, I don't trade it. I wait for it to form. If it does what I think it's going to do, then it gives me insight to work with the later part of the day. But that's not something that, is an invitation for you as a developing student to go in there and say, wow, it's a fast mover. Look at that. I want to trade that. No, you don't. There's no forgiveness. If you're wrong, there's none. You get hurt quickly and bad. It moves so fast, your stop loss won't work. You won't have the protection that you don't appreciate at other times when the market's not as fast. CPI will tear your face off. It'll literally take your face right off. If you're on the wrong side, you're going to wish you stayed in bed. Trust me. But anyway, I promised you 2 live streams. I gave you 2 live streams this week. If you found this one insightful, if it was helpful to you, if you like learning this way, which removes all the emotion, you don't have to worry about being right about making money or not losing money. You sit down with somebody that's been doing this a long, long time, using the logic that I've taught, not creating something new, not making something up as I go along. I'm using the information I've already taught on that channel. It's all there. All you have to do is spend time with me. That's the missing part. The missing part is being under my wing, watching it live. That way you can learn to see that it's real. You can trust that it's really going on. It's something you can time. I think that's what I was talking about earlier. The 60 minutes. You can avoid most of the things that you were worrying about when you first started learning about trading and wanting to get involved in this. Where do trades set up? Do I trade the Asian session? Do I trade the London session? Do I trade the New York session? What do I trade? Do I trade the afternoon session? Do I trade the lunch hour? Do I trade lunch, the London close time frame? What do I trade ICT? What pair do I trade at that time frame? You have 1,000 questions, right? All you have to do is look at that 160-minute interval right there between 10 o'clock and 11 o'clock, New York local time. Your entire model, all of it, can be inside that 60-minute window. The problem is, it's not going to be enough for you. You'll outgrow it, or you already anticipate outgrowing it, so therefore it's not worth your time. I got to be doing 50 other things, chasing whoever else is hot on the internet. Or ICT's talking about this other thing, because he's got all these things he's teaching the rest of this year. So I'll come back to this, but let me look at the other stuff he's got. Like the people that are asking me all the time, which videos should I watch? I'm new to your channel. You should watch the live streams and the 2022 mentorship. It's only 40 videos. That'll give you something right away. Going into your charts, you don't have to go through thousands of videos and thousands of hours and not knowing what to do with all that information, because it's a lot of content, but that will make you an animal, a beast, okay? You will be a savage if you go through all that core content. I promise you. But you have to go through this first. Sitting with me, watching it live, explain to you why it should do what it should do. Because you want to ferret out whether or not you should be underneath me as a student. Watch my live streams. Because that's the testimony right there. That tells you right away, in no uncertain terms, there's no extra other thing. There's no other monitor being recorded that did something else. Okay? It's all cherry-picked the right way in front of you live. Explain to you why it should behave this way live before it happens. The very moment that it's going to happen, where it should go, where it should stop, where it should form a setup, all those things. And you don't need me pushing a button for that. A mature, ready-to-learn student does not need to see that, because you already know this is where a fair value gap entry is. This is where your stop loss would be. You don't know? Watch the 2022 mentorship. It's explained to you in great detail. You see me executing with it in those videos. You don't need 1,000 different examples of that. If I wrote a book with it, would you have 1,000 examples shown in the book? No. But you'd be, oh, this is the greatest thing in the world. This book is amazing. and it's not. This is the amazing thing. Watching me outline what the market should do live. This is the part that mentoring is. It's not talking about what's already happened. Here, I took a trade over here, and they don't even have the execution shown. They don't show their trade history. They don't show them entering it. They don't show you the stop placement. They don't show you the profits being taken. I don't teach like that. I teach where the rubber meets the road, the brass tacks. We are in here showing it real time. This is the logic. This is what works. This is the marketplace. This is exactly why your chart's going to print what you're going to see later on after the fact. I'm going to tell you before it happens. And it's something that I'm teaching you to do on your own. That's power. That's mentoring. That's elite status. When you don't worry about ever needing to do anything else. You don't ever worry about buying another book, following somebody else's strategy. And I'm not trying to disparage anybody else doing something else. But I promise you, once you learn what I'm teaching, you don't need that anymore. You don't fear what you're going to do in the future. You know how you're going to trade. Oh, now I know how to supercharge all this information. It just came back to me. Thank you, Jesus. How can we supercharge this idea? I knew if I stayed here long enough, he'd give it back to me. I wasn't letting go until I got it. We would have been here talking until 2 o'clock, and I still would be trying to wait for it. It's all right. Wait on the Lord. So between 10 o'clock and 11 o'clock, if you want to supercharge this, if you have a market condition that's not like what we have right now, where we're stuck in that range on the daily chart, if you trade on the days that in a weekly profile, meaning where, for instance, a classic bullish weekly profile would be a Tuesday low of the week in London, okay? If you used a market environment that has a seasonal tendency for the market that you're trading, and we'll say ES, okay? If you are in a seasonal tendency for the ES to trade higher for the next couple weeks, you should be really trying to do most of your analysis with that expectation to try to look for longs. And if that is the case, if you are trading on Monday, Tuesday, and if the low really hasn't materialized in a stunning fashion by Wednesday's New York session like this, the tendency for you to capture a big move is there using that weekly profile. Trading inside of this 10 o'clock to 11 o'clock time window. Those silver bullet trades will be phenomenal. Because what are you doing? You're participating in a larger, higher time frame price run based on a weekly expectation inside of a seasonal tendency that is in alignment with the side of the trade you're taking, whether it be a bullish seasonal tendency or bearish seasonal tendency. Whatever you're doing at that time, you're really placing everything in your favor in that direction. So you can really supercharge your trades with this little window. It's not like this takes you out of those types of trades or one-shot, one-kill trades. No, you can participate in them with this. And in fact, you might not be able to get yourself in with how I teach the one-shot, one-kill entries. It would typically be usually earlier in the morning or in London. Say you couldn't be there for that, or you missed it. It's just you weren't paying attention. You know, you're watching somebody else's videos and trying to learn some kind of harmonic garbage. You missed the trade. Oh man, if I wouldn't have done this or that, if I wasn't fixing the car, changing the oil, helped my wife with the laundry, I would have caught that trade. And you know it's a one-shot, one-kill, but you missed it. What do? Well, wait till 10 o'clock, till 11 o'clock, and wait for your silver bullet. Don't believe me? Go back to and look through your charts. It's there. It's always there. Always. And it will always be there in the future. It will be there, folks. I promise you, I guarantee you, it's going to be there. I say this because I want you to not trust that. And in every day show up, expecting it's going to fail. And I'm going to be pleased to deny you. And over time, you will be converted. You're going to see it. You're going to see the light. You're going to see the truth. And the bottom line is this stuff works perfectly. You, as the operator, you're going to do it wrong. You're going to do something wrong, just like sometimes I do. I have a lot of scar tissue because I hurt myself a lot when I was a younger man, forcing my will on something. I have so many examples where I did something wrong but made money. Later lost it, but I did things wrong and made money. And I thought that there was something to it. And if I just go back and try to tweak this and tweak that, there was something to it. No, it was just me being lucky at that time. Luck is not a skill. It's just a happenstance. I just did something without any real logic behind it, and it just so happens that that's what the price wanted to do at the time. That's the equivalent of everything in retail. That's what's happening, but you won't be honest with yourself. You won't be honest. The ones that are honest know that they have a crummy system, but their money management is the secret. And that is what I agree with. Anybody that trades outside of what I teach and is profitable and consistently profitable, you are an exceptional money manager. And you deserve every bit of that accolade. You deserve that. You absolutely deserve that. That is a skill most, and I'm saying 99% won't ever reach. They can be good at seeing setups. They can see the setups, they can have the bias right, everything right. But their funded account says they can trade with 15 contracts. And they did it wrong. But they were right in their analysis. But their risk management was too extreme. They can't manage risk. You're so drunk on the idea of making money that you do everything wrong where it matters most. Trade management, risk management, you have to know that. And you have to know it better than you know your technicals. Because the technicals are the least important. Knowing how to keep your money is the first rule. And so many of you are ignoring that right now because you want to plunge in. I want to try to get funded. My own son, he's discovering that. He's caught up in this, I'm going to prove. Okay. And I'm going to sit back and say that I told you so. You got to listen. You can't do your own way. Your own way when you don't know what you're doing isn't going to work. It doesn't matter how much you risk. It won't work that way. And so many of you are doing that very thing. Instead of just relaxing and learning what it is that I'm teaching, becoming comfortable, being patient. See, that's the problem. You aren't comfortable being patient. You are impatient and you think that's how every trader that's profitable feels. We don't. We don't care if we trade today. We enjoy it when we do, but we're not really all keyed up about needing to do it. Is that a hallmark in you right now? Chances are it's probably not. And that's normal for a new student. That's normal for a new trader. You feel like you gotta go. And that go only leads to just blowing accounts, becoming frustrated sooner, and then wearing yourself out where you don't want to do it at all anymore. And you don't give yourself a chance. And you have to give yourself the right learning atmosphere. And that's how I teach. I teach with all of those advantages, even though it doesn't feel advantageous, it doesn't feel fun, because there's no profit and loss showing. But I promise you, if you take a step back and look at what I'm showing you, why it should do this, that's what every trade requires. Where's it going to go? How can you time when it's going to start going there? And where are you wrong? So that way you can limit risk. So why are you arguing? Why are you wrestling with me? I'm giving you those answers in the best way it can be done, live. Real time over real charts on a very, very small time frame where I have such a thin margin for error. I got to be right. The logic has to be right. And if it doesn't shine through, you'll see it. Have you seen it? Are you witnessing it? I mean, I know what I'm talking about. I know what I'm showing. But are you really paying attention and seeing it? Because I've had students that literally watched me do this for years, insist because they can't do it, they lie. And they say, it's flawed logic, it's no better than anything else, and it doesn't work. How can it do? That's an oxymoron. You can't say that. And what side of the equation is true now? Because you said both sides. It's the person. You're going to do it wrong. You're going to. Everybody does it wrong. I have a long history of doing things early where I didn't know what I was doing. And also did things that I should have done, but I was scared the whole time I was doing it. So it makes me uncomfortable doing those things. What am I referring to? Trading the yen. I don't want to trade it because it makes me feel like I felt before when it hurt me. So to keep that kryptonite effect off of my mindset, I just don't trade it. That's it. It's simple. Just because I have a weakness doesn't mean, oh, my calf muscles are a little weak. Let me go in there and start working them out and build them up. That's not what this is. In this, you lose money. And you can lose more than money. You can lose your sanity, your health, your relationships. So I don't look at it as I have a weakness in trading yen, so I'm going to fortify myself and start only trading yen and desensitize myself to that. No, I don't look at it like that. I know where my limits are. And I know that because I'm obsessively compulsive, my brain will go back to where it hurt me. And it'll constantly be feeling like I'm going to end up in that situation again. So I don't have that feeling when I'm trading ES. I don't have that feeling if I'm trading anything in Forex other than the yen. So there's your answer why I don't like yen. Okay, but and besides, currency is extremely manipulated. It really, really, it's aggressively manipulated. You can do very well with it when it wants to run, but nonetheless, I think I've jawboned enough here. We've been together for about 2 hours. I don't want to go more than that. I didn't want to go this long, but I had to wait and remember what I was wanting to say. In the supercharging aspect in layman's terms, and I'll close. By using higher time frame analysis, and you're expecting larger range on a short term to swing basis, in other words, a trade that lasts several days to a couple weeks, if you use this 10 to 11 trading in the ES market or NASDAQ, and let's take a look at the NASDAQ and see if it materialized there. But by incorporating a higher time frame element to it, you can have a participation in those bigger price runs. And instead of taking all of your trade off at 5 handles or whatever your target would be for that liquidity within this 60-minute window, that you can take a portion off and leave like one contract on and leave it as a runner. Okay, so there's your fair value gap. After it leaves the consolidation here, it runs up. You're probably asking, what is this orange level? To be honest with you, I don't recall off the top of my head what it is. So I have to go back here and go through the time frames and see what it is, because now it's bothering me too. It's going to be in a 5-minute chart on Tuesday. Yeah. Maybe 3-minute chart, 5-minute chart. I know some of you are like, ICT, if you do this thing here on TradingView, you can scroll back. I hear you talking. I just don't know what I'm doing with it. There it is. It was that imbalance I had at the time, and I just left it on the chart because I wasn't watching NASDAQ, so that way you can see what it was. It has nothing really to do with anything today. But there's a consolidation. We rallied above it. Fair value gap. Old high. Silver bullet. What's it going to run for? Relative equal highs, buy side. So buying in here, getting out about here. 20 handles or so. But we've already seen this one run. So would you buy that one? No. Go back to Six Sister. Six Sister. This is the strong one. So it's done majority of its run already versus Dow. relative equal highs. And I think it was, what was it? 33,880, I think it was. Lower time frame, high frequency trading would use that on a 5 second, 10 second, or 15 second chart. It would buy an imbalance in here and target these stops above there. So I don't want to buy the weakest one, because it's not always going to be, the weakest one's going to be the best one to trade, because it's going to have a lot more room to catch up with. It may stay weak throughout the session or the day. So the one I'm looking for is the one that was not weak, but didn't keep up with NASDAQ. And it made sense technically. We had a bullish breaker. And we were watching a PD array to expect it to fail. We're anticipating price failing to send price lower on this fair value gap. So we want to see it give way, open, trade down to it on this candle, it rallies, fair value gap, there's your silver bullet, boom. Okay. So that's going to be it, my friends. I hope this was helpful to you. Hopefully it was insightful to you, that it allowed you to get more understanding about what it is that we're doing, what we're waiting for, and you can clearly see that it's going to take a little bit more effort than you thought, but it's okay. You'll be fine. Just keep showing up. The time with me, the things I'm talking about in Twitter and the reviews I'm doing and the lessons that I put up on the YouTube channel, you will learn this. It won't happen overnight. It won't be real quick. It won't be real fast. It won't be a 5-minute trainer that gets you here. Okay? You have to see it being done, not in market replay, not after it's already happened in teaching as a tutorial. You need to see it live, explain why it should do this, why it shouldn't, because you can't replace that now as experience. You watched these candles paint with me. You watched with the expectation of, I'm either going to be right or I'm going to be wrong. What did it feel like? Did you feel like it was not going to pan out today? Did it feel like it was going to be going the other direction? How did it feel for you to see it materialize and develop like we wanted it to see? That's a learning experience for you. Some of you, it's probably exhilarating to see, wow, this is, again, it happened. Yeah, again, it just keeps happening. And over time, you don't get emotionally stimulated by it. It's just something that you expect. You know, when you get in your car, you're going to put the key in it, and you're going to turn the key. What's going to happen? Or now, some of the cars, like I have, all push button, but some of you may still have a vehicle that has a key that you put in there. Either way, when you start your car and you push the ignition or turn the key, what is your expectations? That the car's going to start up. So that's expected. Are you smiling and laughing and, whew, I'm glad this thing started up today? No, you're not. That's what you want with your trading. Now, what's going to happen is you're going to sit down one day and you're going to sit just like you're getting into the driver's side of your car. You're going to try to start your car and it won't. What do? You deal with it. Battery, starter, mechanic if you can't do it on your own. It means what? Missed opportunities, costs, which is a loss monetarily, and frustration. Well, guess what? That's the way trading is sometimes. You're going to get behind the wheel of your unique model. You're going to believe that you're going to get somewhere, and you're going to get in behind the wheel, and it won't go. And it might come back and take you into a loss. Does that mean that your car's never going to start like you want it to in the future? No. Does that mean your trading model is never going to give you a trading setup that pans out? No. But when you're new and you don't have the desensitization that you put yourself through by watching price without pushing a button, you're bored. You know these things are going to happen more times than not. Not 100%, but more times than not. Then you don't worry about the times that it won't work for you or that you're going to do it incorrectly. And you want to learn how to do this incorrectly and make the mistakes in the beginning so that way you learn from them without any monetary loss. It's normal for you to do it wrong here, and give yourself that permission. There's no scorecard, there's no report card, nothing. It's all learning. Taking in experience that you can't get from a book, and you can't get it from a market replay. Think about it. If I showed you this stuff in a market replay, not market replay, but I did a review last night on ES, and admittedly, I could have, if I wanted to, be what everybody thinks I am, I could have been beating my chest and saying, see how smart I was and right I was about the CPI expectation I had before CPI number on Twitter. And it delivered like I would rather have seen. But because I know it's CPI and I already taught and teach my students not to look at that report as something that's tradable before it releases, I just commented, okay, there it was. And reminded you all that I don't usually get it right. So that's the reason why I don't trade it. But if I hadn't talked about it on Twitter and I had just said, yeah, I thought I was going to do this, it falls on deaf ears. And some of the lessons that I have needs to be in the presence of real-time data. That's the only way you can learn it. It needs to be seen. So, like if I said today in a review video, like say I sat down tonight on YouTube and I said, okay, look at this fair value gap here on the 5-minute chart, and I thought that it was going to go through this and it's going to be a point of inversion where if it went above that, it would start aiming for this. And of course, it looks like it's cherry picked, it's hindsight, and everything makes perfect sense because it's already happened. That's not what you experience today. And that's not what you experience when we have live sessions together. And that's not what you experience when I'm talking about things on Twitter. I'm taking you right to where it's going to happen, where it's going to go to, and where to focus. And over time, what happens is you get real comfortable with a specific thing that I talk about that will repeat enough times for you to trust going into back testing it, looking for it in old data, old moves, seeing how often it formed. And then that becomes the initial profile that you start studying under, which eventually becomes a major contributing part to your model, which will be refined over time, and you'll find consistency with that model. Not 100%, not 100% accurate, never taking losses doesn't exist. But you'll get real comfortable with the times that it does lose. It's not enough to scare you away from using it. And you won't risk so much when you do trade that even if you did do it wrong, it's not taking you out of the game. It's just like a flat tire. A starter that went up in your car. It sucks. I got to go buy that and got to find a way to get there because I only have one car or whatever. It's a nuisance. That's what losing is in trading. If it's done with an impeccably controlled approach to risk management. But if you're out here, playing Johnny Quest, and everything's an adventure and you want to go maximum leverage, I dated myself. Not you probably, the younger cats probably know about Johnny Quest from the revamp, but I'm talking about the one from the 60s and 70s. But the idea of over-leveraging, you don't realize the effects of doing that to yourself when you don't know how to trade. You make yourself afraid to take a trade then. You might be amazing in a demo. You might be amazing in paper trades. Why? Because you're managing risk. Oh, what did you just say? Exactly what I just said. That's what you've never understood. People that do exceptionally well in paper trading and demo and fail in live trading, you know what the problem is? You're risking too much. But ICT, I'm trying to do 3 contracts because they said I could do 15, so I think 3's fair. Wrong. No, you should be trading a micro. But I can't get rich. We're not about getting rich. We're about being consistent and making bread, making ends meet. You can get rich later on. Right now, you got to get money. They ain't going to come in wheelbarrows in the beginning. Small knots here and there. See, with the demo and paper trading, I know we're supposed to close this, but I missed y'all, so I got to talk to you. Did you miss me? Give me a thumbs up if you miss me. So when you're trading with demo and paper, the reason why you're doing so well is because you're managing risk. You are not able to assume a loss that would hurt you, which is the right way of using a demo. But you should not be doing 100 contracts to show you can show a $25,000 or a $50,000 win. That's nonsense. You're not going to trade that way. You don't have that money. Even with a funded account, you're not going to trade that many contracts. So what should you do? Trade with the smallest size, even in demo. 1 micro. Condition yourself to trade like that. But you don't want to do that because it doesn't feel like it's fun. It doesn't give you that video game feeling. And this is not a video game. You're conditioning yourself to expect something in terms of a video game. And then when you get there and you start trading with real money, it doesn't feel like a video game then, does it? It feels like it's life or death. You can't breathe. Your heart's beating heavy. You feel dizzy. It sounds like a video game to you? No. It sounds like you're in an emergency. You're in a fight for your very life that you put yourself into. You put yourself in that situation. You can take yourself out at any time, but you're doing it. So by trading with the smallest leverage you can trade with, the micro, only after you've done trading, paper trading and demo trading for 6 months, there's no way you won't be successful then. But you're not going to be successful then. But what if you're not going to be successful if you don't at least consider doing it without real money consistently for 6 months? Why 6 months, ICT? Well, because you can get lucky for 3. You can develop bad habits in the first 3 that will materialize in the next 3. And it'll prove to you you're not ready. And you have to listen to yourself when you see the evidence that you're not ready. How do you know you're not ready, Michael? When you are antsy and excited about taking the next trade and you just can't do anything else but that. You know, you're all hopped up on goofballs. You're in here playing around your Venmo account, your paper trading account, and you want to see these numbers flashing, and you can't spend it. You're not ready for real money. I promise you're not ready for real money. You're not even ready to try to get a challenge passed with a funded account. You're not ready. You need to be bored. Yeah, it's going to do this. I expect it's going to do that. Boom, bum, there it is, done. And you're able to do that consistently, 70% of the time. Consistently able to do that in paper and in demo. Then it's a time to start considering maybe, and you'll have to decide that if it's right for you or not to try to go for a funded account or trade with live funds. That's a decision all of my students make on their own. I never tell them, now you're ready. You're not ready. There you go. But that's why paper trading and demo trading is so good in your hands, because you're trading with risk managed impeccably. You can't lose. So therefore, you're doing what? You're dialing in on the analysis. And that's the problem when you start trading with real money. You start worrying about what happens if they ask me what my trading results are today. What happens if the broker is watching me? What happens if I blow my account? What happens if I blow my funded account? What happens if I fail my challenge? What happens if my dad sees that I had to pay for another account? Hello. Yes. All of these things are within your control. But you paint these scenarios like it's something outside of yourself that's putting it on you. You're rushing the process. You need not rush it. And I promise, if you treat this like a business, believe me, businesses they don't run like a Chuck E. Cheese, okay? They run a establishment for kids to go in there and be a kid, but you don't want to run your trading business like a Chuck E. Cheese, okay? Where every trade has a chance to be a kid. No, you don't want that. If you let your child run out there in the yard with no parameters, like no fence, and you're near a street, are you going to feel safe about your child being out there? Where's your stop loss? The fence, okay? And if you're smart, within arm's reach and a fence with a lock that doesn't open except for you being able to open it. That's you controlling risk. But most of you only go out there trading and trying to do these funded accounts, trying to pass it in 3 days, 5 days. You can do a minimum of 5 days and you gotta have to pass it. And you think that's what you have to do. Who said that? That's why these companies are getting rich off of you. Because they know that the parameters they placed on that funded account challenge is so above the average new trader that they're going to constantly get those restarting fees. And that's what they're banking on. Slow down. Slow down. Learn how to do this, and you'll walk through it with no problem. If you rush, I promise you, you will regret it. You won't be where you want to be. You'll spend more time and money doing something that wasn't fruitful versus just listen to the old man tell you this is the way it's supposed to be. Boring. Condition yourself for months where you can do this without being enticed to trade with bigger leverage, more contracts, more trades. This is the way you do it. Professionally minded traders that are consistently profitable, they're not gambling. They're looking for something that is measurable statistically and historically. They can see it repeats a lot. And that's their model. Are you doing that right now? Or are you in Chuck E. Cheese trying to take another ride? As long as you got tokens in your pocket, you got money in your account, you haven't hit your max loss yet for today, you got tokens to play. Well, you won't be around long. And all I'm trying to do is give yourself the chance that you're not willing to give yourself right now. And the logic that you have to hang on to get to that point. And once you get here, and once you know what it is you're supposed to be doing and what not to do, it's like riding a bike. You don't forget. And it's a skill set for life. And it's transferable. You can teach your kids, your friends. Like, it feels good to be able to take this information and transfer it into your hands. I love it. I know in the right hands, it's going to change a lot of family trees. It's going to save a lot of marriages. And it's going to provide a greater appreciation for life for some of you that never really thought you were going to be much except for whatever your job says you were. And I know what that felt like for me. They're never going to look at you like they should. So always be working towards divorcing them as your employer. They have a ceiling on how much you're going to make and when you can vacation and spend time with your family. Make a plan, submit to the things I'm teaching you, so that way you can fire them. It's okay, you're not going to hurt them. They'll find somebody else. There's another Carl waiting in the wings to take your spot when you're gone. But when you leave, you can do so confidently because you didn't do some demo stuff that you have no real trust in. You just got lucky over leveraging. You don't want that. You want to have consistency, doing the smallest and still being able to prove that you can find profitability in it. And then over time, then you can slowly amp up that leverage. But it has to be controlled and measured. You can't just simply go out there and just, it's all in. It's not Texas Hold'em. So, I've said what I want to say today. I shared what I wanted to share today. And I think that's going to be it. So, I won't be live streaming the rest of this week. I don't know when I'll do the next one, so I'll let you know on Twitter when I'll do the next one next week. So, until I talk to you again by way of Twitter, for those that follow me on Twitter, enjoy the rest of your day, be safe. And for those that only watch my YouTube videos, enjoy your weekend. I'll talk to you next week.